Good morning, everyone. We're gonna get started here with some housekeeping items while we allow the remaining attendees to get logged in here. Thank you all for joining us today. We're going to be talking today about learning more about pooled trusts and how this program can help people with disabilities and older adults with chronic health conditions be able to qualify for Medicaid to cover community-based long-term care services while preserving as much of their income and assets as possible to be used to support their daily living needs, monthly expenses, and purchases that may improve their quality of life. In today's webinar, we will provide a brief overview of pooled trust and how to use this program to qualify and maintain eligibility for Medicaid benefits. And we're also going to discuss the new look-back period for Community Medicaid, what this means for the people that we serve who are in need of long-term care services either now or who may anticipate needing these services in the near future. My name is Sarah, and I'm the Director of Outreach and Community Relations at NYSARC Trust Services. And we're presenting this training today as part of the virtual Disability and Elder Law Fair in partnership with the Finger Lakes Independence Center and the Tompkins County Office for the Aging. So thank you to those organizations for giving us the opportunity to share this information with you today. NYSARC Trust Services is a not-for-profit organization that was established in 1972 by the ARC New York and has helped more than 20,000 people with disabilities and older adults with disabling chronic conditions protect their eligibility for means-tested government benefits and be able to utilize funds that they would otherwise need to spend down to purchase items that would improve their quality of life. This program enables people with disabilities to be able to get care in the community while still being able to afford to live at home. NYSARC Trust Services is a statewide program that serves people in all counties of New York State. And we were among the very first in the country and in New York State, especially to administer pooled trust for the Medicaid income spend down. Following today's presentation, you will receive an email with a link to complete a brief survey. We ask that you please take a few minutes to just provide us with some feedback about this program and any other topics that you'd like to see us present on in the future. Your input is greatly appreciated. We would love for you to, we'd love to hear from you. You will also find copies of this PowerPoint presentation in the handouts area of the GoToMeeting toolbar. I would encourage you to go over and download the copies of the slides now, in addition to some other resources that we've provided you. Once the webinar closes, you will not be able to download those documents. So at some point before the end of today's training, go ahead over there and get copies of that if you'd like those. Certainly, you can always contact us after the training as well. If you need copies, we can always email them over to you. Everyone is muted by default, so we encourage you to use the questions feature in the toolbar to submit questions throughout the presentation. We will hold all questions until the end and probably review those in the last 15 or 20 minutes of the webinar. We'll do our best to get to everyone's questions. Again, our contact information will be available if you have anything more specific you want to talk about. You can always reach out to us following today's training. This webinar is being recorded as well, so we are happy to share that. If anyone would like a copy, feel free to reach out to us. All right, with that, it looks like we've got majority of attendees logged in, so we're going to get started. So a pooled trust is a special type of irrevocable supplemental needs trust. These trusts were designed to allow people with disabilities and older adults with chronic health conditions to be able to give them a vehicle to spend down money that would otherwise impact their eligibility for means-tested government benefits. Either someone who's looking to qualify for these benefits or who's already enrolled who may receive a sum of money that could impact their eligibility for benefits. And what a pooled trust does is provides a vehicle for someone to deposit that money into a trust account which is going to be managed by a not-for-profit organization. Will administer the account on behalf of the beneficiary of the trust, the person with a disability, in order to help them qualify for these means-tested benefits and also be able to continue to utilize that money for their either living expenses or purchases that may improve their quality of life. Now today we are going to be focusing on using a pool trust for community-based Medicaid long-term care services. However, a pool trust can be used to protect Medicaid benefits that are simply basic health benefits, not necessarily for long-term care needs, and also other means-tested benefits like supplemental security income benefits, where someone may come into a sum of money that puts them over the $2,000 resource limit for SSI. However, when we're talking about a pooled trust to obtain eligibility for community-based long-term care services, the goal of this program is to allow people with disabilities and older adults to live safely and comfortably at home and in the community or some community-based setting for as long as possible. And that may be in their own home with a loved one, or perhaps in a community-based setting like an assisted living facility. In order to utilize a pooled trust, someone needs to have a qualifying disability. And this is the Social Security Administration's definition, meaning that a person is unable to work for a period in excess of 12 months, unless of course they're participating in the Medicaid buy-in program, which would be kind of the one exception to that rule. The important thing to point out when talking about individuals that we serve who are looking to access community-based long-term care services is that many older adults who are in need of home care services may not necessarily consider themselves to be disabled. However, as we get older, the types of chronic conditions that older individuals face often are going to qualify them to utilize a program like this. Again, someone who's in need of assistance with their activities of daily living is typically going to qualify. They just may need to document that disability with their local Department of Social Services in order to be eligible to utilize a pooled trust. All pooled trusts have a trustee, a not-for-profit organization that serves as trustee. That is a requirement. And in New York State, there's a financial institution that serves as co-trustee. In our case, we work with Key Private Bank, which is an organization that has more than 190 years of fiduciary and wealth management experience to assist us with the investment management of funds if someone is depositing a larger amount of money, like resources. All of the funds in a pooled trust are truly pooled into one bank account to give them more favorable cost savings and investment power for more modest sums of money. However, as far as the individuals you're working with, their activity will be tracked separately in a sub-trust account, which means whatever money they put in, minus any cost to administer the account, will be available to them to utilize for eligible expenses. The trust is irrevocable, meaning that once it is set up, you can't change the arrangement of the trust or simply get the money returned to you. If someone could deposit money into a pooled trust and then have it given right back to them, it would be considered available to them. And so this irrevocable piece is very important to protect a person's eligibility for these Medicaid benefits so that it can help them qualify, but also maintain eligibility for those benefits. Pooled trusts are primarily used to help someone spend down surplus monthly income when their income on a monthly basis is above the threshold for Medicaid eligibility, and can also be utilized to shelter excess resources, either to qualify or maintain their eligibility for benefits if they come into a sum of money that might deem them ineligible or put them over the resource limits for Medicaid eligibility. These are first-party trust programs, and just like any other first-party supplemental needs trust under federal statute, the account will close upon the passing of the beneficiary, and any funds that are not retained by the not-for-profit organization administering the trust would go back to the states that provided Medicaid services, up to an amount equal to their Medicaid lien. And so in most cases, because people are using the money in the same month, there's very small balance in the trust when someone passes away. And so the funds are typically retained by the not-for-profit organization to support other people with disabilities that are served by their philanthropic mission. Now, in order to qualify for community-based long-term care services in 2020, a single individual can never have more than $15,750 in their name. And if it's a married couple, you're going to be, they're going to take into account your resources collectively. And there's some different budgeting options for married couples depending on the individual's situation. But resources are going to be cash or assets that can be readily converted into cash. Now, currently, under the current Medicaid laws, an individual who may have money above these resource limits is able to transfer or spend down those resources to these financial limits and qualify for Medicaid in the following month, because currently there is no look-back period for community-based Medicaid services. Now, beginning October 1st, there will be a look-back period, and transfers that are made after October 1st, 2020 may be subject to a penalty period if there was a transfer made after that time frame. And we'll go into that in a little bit more detail. We're going to start off by just going through how to use a pooled trust now under the current rules, and then we'll talk about the new Community Medicaid Lookback and what that may mean for pooled trusts going forward. Many of the individuals you're working with also may not have a resource issue. They might not have money in the bank that puts them above those limits. They may qualify from a resource standpoint. However, they may find that their income on a monthly basis is still above the Medicaid limits, meaning that their total amount that they receive from Social Security or pension or any other sources of income that they may have is above the 875, or again, if it's a married couple, above those other thresholds. They need to spend down that money on a monthly basis in order to qualify for Medicaid services. And when it comes to monthly income, there are really only a few options to spend down these funds. The first is you can just simply send a check to Medicaid for the amount of your spend down. So let's say the individual has $1,000 over the Medicaid limit. That's the amount that they're going to send to the local Department of Social Services in order to qualify. And each month they'll need to submit that money before they're eligible. Another option would be to spend down the funds on qualified medical expenses. The individual would need to keep track of records of the payment of those expenses and supply those to the local Department of Social Services in an amount equal to their spend down deposit before Medicaid will begin providing coverage that month. Now, unfortunately, in each of these options, the individual does not have the ability to utilize that excess income for things like their monthly living expenses, which can put a lot of people with disabilities and older adults with disabling chronic conditions in a tough position where they need the Medicaid benefits, but if they give this money over to the county, they may not be able to continue to live in the community because they can't afford their bills any longer. So in New York State, there's a third option where the individual can deposit that money into a qualified pooled trust on a monthly basis and use that money for things that are not medical expenses, things that are not covered by Medicaid, and go above and beyond what their Medicaid benefits are providing, which gives people the ability to pay things like their rent or mortgage or utility bills, things that are going to keep them in the community, and perhaps even some purchases that may improve their quality of life. Now, the order of these steps may vary depending on the individual's situation and where they are in this process. But typically, if someone's looking to qualify for Medicaid community-based long-term care services for the first time, they have to start by looking at the resources first. There are a variety of planning options for them as far as ways to transfer or spend down resources to reach those appropriate levels. And currently, at this time, if someone makes a transfer for community-based Medicaid, they're able to qualify or apply in the following month. And they really only have to worry about if they're going to go into a nursing home in 5 years under the current rules. Once someone has reached that resource limit, they're able to begin that Medicaid application process. If the individual is not already deemed disabled, they may need to do a determination of disability with the Department of Health. But for individuals who are receiving SSDI or SSI, those are situations where the individual would not need to do a determination of disability. They're already deemed disabled. The Medicaid application can take up to 3 to 6 months, specifically for long-term care services. It can often take quite some time. However, under the current rules and adjustments that are being made under the COVID-19 pandemic, this has actually been streamlined quite considerably. And we are seeing things get processed a little bit faster than before. So that's certainly something to keep in mind if you have somebody who's looking to apply for Medicaid, that the process may be very, very simple right now. And again, if they're looking at that impending change to the Community Medicaid rules, doing that sooner than later may benefit their situation. The pooled trust application, however, is very quick. We can apply and open a pooled trust in about a week's time. So it's really up to the family to decide at what point they may want to apply for the pooled trust. But we have also heard down in the downstate region that it is beneficial to apply with the pooled trust because there is a time limit by which that they need to give you an approval by at that point. So certainly if you have a question about when would be the right time, that would be something perhaps to contact your local Department of Social Services or Medicaid, or perhaps a legal professional in your area who might be able to provide you with some insight on the best order of these steps for your particular situation or for the client that you're working with. Once the pooled trust is in place, they can begin depositing their monthly spend down into the trust. The trust will provide a verification of deposit to the local Department of Social Services as needed. And Medicaid will come out, provide an assessment, and determine the amount of care for the individual. And the funds that are being deposited into the pooled trust can then be used for the beneficiary's living expenses, personal needs, and things that are for their sole benefit. Now, the process to establish a pooled trust is very quick and easy because the documents are already in place, have already been drafted and approved by Medicaid and the Social Security Administration. So as a legal professional and attorney, you do not need to draft the trust document. It is simply a matter of the individual completing what we call a joinder agreement to join the pooled trust. It is about a 9-page document and requires mostly basic demographic information, can certainly be filled out by a family member or caregiver service coordinator assisting someone. It does need to be signed either by the individual who is benefiting from the trust, the beneficiary of the trust, or an agent acting under power of attorney, or a legal guardian or parent of perhaps someone with a disability can also sign on their behalf, provided that they have the authority to establish and fund a trust on behalf of the beneficiary. This document does need to be notarized, and I would mention that during this time, we know that many of the people that we are serving are at high risk of complications from COVID-19 and are isolated at home without the ability to go to a bank or to go out and get a notary. And under the current executive order, NYSARC and many other pooled trusts are able to provide virtual notary services to a client. So if you have an individual who's not able to get out to get a notary, this is something that can be done virtually under the current state of emergency that we're in. There's also some supporting documentation that would need to go along with the application. Each pooled trust might be a little bit different about what they require. I can really only speak to our program. We're looking for information that's going to help us verify the Social Security benefits. So that would be a copy of the Social Security card and Social Security award letter. Or if someone has a SSA 1099, we can take that in lieu of the other documents, and that will give us everything that we need. In our program, in addition to the signed application, the supporting documentation, the individual will provide a bank check or money order in an amount of $300 or more in order to establish the trust account. Now, if the individual knows what their spend down is going to be and it's greater than $300, they can open with their first spend down deposit. If it's less than $300, we do ask for a minimum of $300, and that's to cover the one-time enrollment fee and leave some money in the account for the first month's fee and to establish the bank account with a balance. If the individual is making monthly deposits into the trust, we do ask that a minimum balance equal to 1 month's spend down remains in the account at all times. And that is to protect our beneficiaries. This is a pooled trust, is to protect our beneficiaries from overdrafting into each other's accounts and to allow us to pay bills more quickly by not having to hold their check on a monthly basis, waiting for the funds to clear. Because we have this reserve of funds, as soon as we receive their deposit on a monthly basis, we're able to begin using that money to pay their bills so we can ensure things are being paid on time. However, we understand if someone has a $1,000 spend down, that can often mean that the first spend down is not able to be used towards their expenses. And so knowing that many of the families that we serve have been hit particularly hard during this pandemic, we are offering individuals who establish an account before September 30th the option to reduce that minimum balance requirement to only $100 rather than their full month spend down, provided that they enroll in monthly electronic deposits. And if somebody has any questions about that, please feel free to reach out to me. The cost to set up and manage a pooled trust are very affordable, especially compared to an individual trust. There's a $200 one-time enrollment fee. I believe we are one of the lowest out there in the industry, but they typically range anywhere between $200 and I think I've seen it as high as $350 in New York State particularly. If the individual is making monthly deposits, and that is a one-time charge. If the individual is making monthly deposits, their monthly fee to administer the account for NYSARC to pay the bills or for the pooled trust company to pay the bills on behalf of the individual is going to be based on the amount that they're depositing each month in our program, starting at $30 a month. And everybody calculates this a little bit differently. Some pooled trusts do a percentage of the deposit, others are a flat fee like ours. If the individual is not making monthly deposits, like they simply came into a sum of money from inheritance, retroactive Social Security benefit payments, settlement proceeds, the individual's monthly fee will actually be based on the balance that's in the trust at the end of the month, which starts as low as $20 a month, making that, again, a very affordable option for someone who might only be receiving a modest sum of money, but also for someone who is receiving larger sum of money to help them be able to use more of that money for their ongoing expenses. We don't charge any sort of annual fees. However, there is a cost for the trust to perform a tax and audit. This is where we're doing the tax reporting for the trust, and we also have an independent CPA firm come in and audit our operations on an annual basis. And depending on which trust program someone's in, that will be charged annually in July for an amount of $25 to $50. Now, beyond the administrative costs, there are some nominal investment management fees from the bank, the co-trustee of the trust that does the investment management. And those are a very small percentage of the balance at the end of the trust. And for those that are using the trust for monthly deposits of income, it typically amounts to a couple of dollars. Beyond that, that covers all of their trust activity with no limit on how many requests they can submit, on a monthly basis and will allow them to get access to all of the various services that are provided by the trust. Again, with no sort of fees charged on an annual basis to renew the account. However, there are pooled trust programs out there that do charge an annual renewal fee, so that's something that you'll certainly want to look into and take into account if someone is looking at a program that will charge that when you're looking at what will be the expenses for the client I'm working with. Once the person's account is set up and they're ready to begin making their deposits and using that money to pay for bills, they can make deposits on a monthly basis electronically by giving us their bank account information and picking a date that they'd like us to pull the spend down deposit out of their bank account into the trust, or they can mail a check each month as well. When funds are available to begin being used for purchases, they can submit requests to the trust by fax, mail, or email to provide us with copies of bills and things that they'd like the trust to pay. Again, there's no limit on how many bills someone can send in on a monthly basis. And in our program, we process disbursement requests every day to ensure timely payments. However, there are programs that may not process requests daily. They might do it on a periodic schedule, and that's something to keep in mind when you're looking at different options and figuring out what's going to be the right fit for somebody. That could potentially put someone in a position where their bills are being paid late if they don't get the documentation into the trust on time. So it's really important to just consider and keep in mind. Most pooled trusts are also now able to do electronic payments to participating vendors. So where previously we would have to cut a check and mail a check to the organizations to pay, third parties to pay for bills, we're now able to electronically wire funds to participating vendors like Verizon Wireless, Con Edison, those larger companies that we're paying a lot of utility bills, for example, to, which is helping pooled trusts pay bills even faster. Another great way to help reduce the work for the families that you're working with is to take advantage of the automatic payment options that are provided by pooled trusts. This is where someone can apply to have a fixed recurring expense that does not change from month to month and have that paid automatically on a date that they choose for a period of time. So traditionally, most trusts are offering automatic payments for rent and mortgage. In our program, we do property and condo maintenance fees as well. And we're really excited to announce that we have expanded into car loans and lease payments and irrevocable pre-need funeral arrangements as well. Again, many of the people that we serve are currently, isolated and without access to the normal supports that they have to be able to use the money in their trust. And so by expanding these automatic payment options, we can really help reduce some of that work for these families and people who may not be able to get out to submit requests on a monthly basis or who maybe don't have someone to assist them. I also want to just highlight, we have a nice video here, which I'm not going to play right now, but I encourage you to, after today's training, check out the video. It gives a really great overview from a former beneficiary of ours to talk about not only the services that she was able to access through Community Medicaid long-term care services because of utilizing a pooled trust, but also, some of the things that she was able to use that money for, which I think is really great to help illustrate that for the people we serve. Oftentimes, people are a bit hesitant about sending their money to an organization that's supposed to pay their bills. And so I think that's always a really good video to share with clients who might be interested in hearing from a beneficiary's perspective. Now, there are some rules about how the money in the trust can be used. The first and really the most important is that the money must be used for the primary benefit of the trust beneficiary. We also need to pay bills to a third party. That means that we can't return money to the beneficiary or their spouse. We're going to pay bills to a third party like the utility company. We cannot pay for items and services that are provided through Medicaid or other means-tested benefits. This is a supplemental needs trust, meaning it's meant to supplement the benefits that someone's receiving and not replace those benefits. And so we cannot pay for services that are intended to be provided through benefits without potentially impacting someone's eligibility for those services. And disbursements must be substantiated by supporting documentation. We need a record of what we are paying for out of the trust to ensure that it's for the primary benefit of the individual and to ensure that it is an appropriate expense. Again, we have a fiduciary duty to ensure that the funds are being spent in the best interest of the beneficiary, and also to provide that documentation to Medicaid if they request it. And typically when we're talking about bills and invoices, these need to be in the beneficiary's name, and that's to satisfy the primary benefit rule. We need the beneficiary's name on the bill, or we need someone to provide some form of proof that the purchase of services was for the beneficiary. So for example, someone's living with their husband, maybe the wife is the one in the trust and her name's not on the utility bill. We might be able to look at the service address and put some documentation into our system to know that even though this bill doesn't have the beneficiary's name on it, this service is being provided to the beneficiary. So if you ever have a question about that, just please reach out to the pooled trust and talk to them. There's always something that either we can find something else we could pay for to free up more money to pay that bill, or again, we could request some additional documentation to satisfy that need. Really, the primary benefit rule means you can't buy gifts for other people. The money needs to be used for the sole benefit of the beneficiary. But if they're living in the house with their spouse, we're going to be able to pay all of the, the living expenses. So that's important to keep in mind. Here's some examples of most common disbursement requests that individuals submit to the trust. Mostly it's someone submitting a bill that they would like us to pay a third party, perhaps a receipt as well. But mostly we're talking about basic living expenses if someone is utilizing the trust for a Medicaid spend down. If someone has a larger balance, they might be able to use the funds for other life-enhancing purchases, but primarily for those that are using a pooled trust for community-based long-term care services, they need that money to pay their bills. So rent or mortgage, utility bills like a cable, cell phone, electric, but may also be things like car payments, insurance premiums, or perhaps different one-off expenses that they have. When we say we have to pay a third party, we mean we pay a business, as in the landlord or the utility company, or we can also reimburse an individual who may have made a purchase on behalf of the trust beneficiary. And this is really important because, again, we can't give cash to the beneficiary and we can't put money back into their checking account. So if someone wants to go out and buy groceries, they either need to put that on a credit card, and we can pay the credit card company, or someone would have to go out and make that purchase on their behalf and then submit those receipts to the trust, and we can reimburse that individual. So that might be a family member, like an adult child. It could not be a spouse, that would be putting the money back into the household, but it could be also a neighbor or a friend or someone assisting them. People can also use a credit card, which can give the people that we serve a bit more financial freedom, where they can go out and make purchases using their credit card and submit that monthly bill along with the itemized receipts for the purchases they'd like the trust to pay. If someone's looking at a larger purchase, or perhaps is having a service performed, they can also submit a quote or an invoice to have us review that before moving forward with a purchase, so that they can essentially have it pre-approved and ensure that the trust will pay for the expense before moving forward with something, for example, as an expensive home repair. There are some things that trust cannot pay for. First and foremost, we cannot give cash to the beneficiary or put money back into their bank account. As I mentioned, the trust is irrevocable. We can't return the funds to the person directly without potentially putting their benefits at risk. We cannot pay for things that are for other people. Again, we're not telling the beneficiary that they cannot buy gifts for their grandchildren, but it just is the money that they get to keep each month can be utilized for things like that, whereas the money that's being deposited into the trust must be used for their expenses. We can't make capital improvements to a property that's not owned by the beneficiary. So for example, if someone's living with their adult child and the daughter would like to redo her kitchen, that's not going to be something that directly benefits or primarily benefits the beneficiary. And so that's something that we would not be able to do. However, if the beneficiary owns the home and the improvement is going to, make the home more accessible for them, or even in the situation where they don't own the home and it is an improvement that is for the accessibility of the beneficiary, that is something that could be considered. Just like we can't put money back into the bank account or give money to the spouse, reimburse spouses, we can't have a lease between spouses. However, we could have a lease between an adult child and their parent, where the mother has moved in with her adult daughter, and she is, taking, she would like to pay something towards the daughter for the expenses. And that could be, simply paying rent to the daughter, or it could be looking at prorating certain expenses, things like that. And if you have a family who's in this situation that might be interested in doing a lease between the beneficiary and an adult child or someone else that's an appropriate individual, certainly reach out to the trust and we'd be happy to provide some more guidance about that. We can't pay rent and mortgage. Obviously, can't live in two places at once. And again, we can't pay for benefits, items that are covered by government benefits. Primarily, this comes up for someone who's receiving supplemental security income, so not so relevant necessarily to this presentation, where if we pay for food and shelter, that could cause a reduction in their SSI benefits. However, there are a lot of individuals now who are starting to private pay for home health services that go above and beyond what Medicaid has deemed them eligible for. And that is something that the trust could pay for if the individual goes out and hires an aide through an agency or is willing to work with a payroll company to pay that individual, again, for hours that are not being provided, that go above and beyond what Medicaid has given to an individual. In our program, and most pooled trusts also have a rule that we do not pay for alcohol, tobacco, firearms, illegal activity, bail, or restitution. This program helps so many people with disabilities and seniors be able to access Medicaid services without impoverishing themselves and give them the ability to stay in the community for as long as possible and avoid a nursing home. And we want to ensure that the funds in the trust are being used to support life-enhancing purchases, things that are going to help them meet their ongoing living expenses and improve their quality of life. And so these purchases are not permitted in our trust program. And again, according to the federal regulations, upon the passing of the beneficiary, the trust account closes, and we cannot make any disbursements after the death of the beneficiary. And so that means no funeral expenses as well. So if you have a beneficiary you're working with or someone who may be, whose health may be declining, we encourage you to contact the pooled trust and talk to the trust about using the money. What are some options to spend down that money to ensure that the individual gets all of their bills paid? And an irrevocable pre-need funeral arrangement could be a great option prior to death. However, it's something we cannot pay for after the death of the beneficiary. There's a lot of ways that people can monitor the activity in a trust account and ways that the pooled trust will support the people that you're serving in reporting to the appropriate agencies based on their trust activity. We offer a live customer service team, which is available weekdays from 8 to 5. Some trust programs have like a dedicated individual that you may work with. In our program, most of the beneficiaries who are utilizing the trust for community-based long-term care services have access to a team of customer service representatives, but we do offer dedicated case managers in certain circumstances. We also have a multilingual customer service team that can assist with communicating with beneficiaries who may need some assistance who don't have English as their first language. And we offer an automated phone line and online portal, which is a secure website. Both of these tools are available 24/7 for the individual to be able to track the activity in their account, check their balance, verify monthly deposits at their convenience. Account statements are also sent to all beneficiaries on a monthly basis. And in our program, we do allow those to go to other individuals as requested. And we don't make, there are no additional charges for sending statements to other family members. However, there are programs that do charge for that, so it's something to keep in mind when you are evaluating options. We can also provide a full detailed activity history when requested by Medicaid or the Department of Social Services. Medicaid may periodically require documentation, request us to show receipts for either a specific expense or a period of time, and that's something that the pooled trust can assist with upon request. In our program, and many pooled trusts also offer the ability to verify a person's monthly deposits. Again, this is a service that's offered upon request, and it can be done monthly if the county is willing to accept that or asks for it. In some cases, it's used for clients who are working with adult protective services to just be sure that the individual is meeting their spend down on a monthly basis. However, it can also be done just simply as a one-off. Most often in the beginning, when someone's getting set up, they might need to provide a verification of deposit. That can be sent from our office, or as I mentioned earlier, can also be downloaded from our online portal. And each year, the trustee administrator of the trust will handle any tax reporting on the trust, which is going to be included, again, in that tax and audit fee that's charged in our program annually in July. Now, we often get questions when someone's considering utilizing a pooled trust that essentially, is there a way for me to get out of this if I no longer need this program? And the answer is absolutely yes. A person can opt out of using a pooled trust if they no longer need the trust. Now, if they still have a spend down and they opt out of the trust, they still need to pay that spend down some other way. But it is something that happens, you know, if someone moves out of the state and no longer needs Medicaid services in New York, can no longer use the trust to spend down, or perhaps, you know, they no longer need the Medicaid services. And in these situations, the individual can contact the pooled trust, opt out of using the trust, and stop making any deposits into the trust. Now, because it is irrevocable, we can't just turn around and return the funds to the family, but the individual can continue to submit requests to the trust to spend down the funds until it reaches a zero balance. Most commonly, when someone is going to opt out of the trust, is when they are no longer able to be served in a community-based setting. Now, this is an individual, this is going to change the situation based on whether the individual is going into the nursing facility for a temporary or short-term rehabilitation, like they have a fall or a stroke, and they're just going into the nursing home for that rehab period, and they have intent to go back into the community. Or it's treated slightly different if they're in the nursing home for a long-term placement, in that they are not able to return back into the community or do not have the ability to do that. And so in the case where someone is just going in for a rehab period, that person still is receiving community-based Medicaid services. So they're still required to meet that spend down requirement on a monthly basis. And they can do that either by depositing the excess income into the trust, or sending that money to the nursing home facility, MLTC, or local Department of Social Services during that time. Now, most people are going to opt to continue to put the money into the trust, simply so that they're able to continue to maintain their living expenses, so that they have a home to return to when they are finished with their rehabilitation. In the case where someone is going into the nursing home more permanently, for a long-term stay, and there's no ability for that person to return back into the community, they will stop making any deposits into the pooled trust. In our program, we would release any sort of minimum balance that's being held and reduce their monthly fee to the lowest monthly fee, since they are no longer making regular deposits. And we would work with the family to help them spend down the funds that they may have available. Surplus income would then go to Medicaid to cover the cost of their nursing home stay. They may be able to keep a small amount of money as an allowance. And the applicant will be subject to the 5-year look-back period for nursing home level Medicaid care. Where again, in this current environment, where when families are planning for community Medicaid, if they made a transfer within 5 years of now going into a nursing home, they could be penalized for that. However, if they made that transfer outside of that 5-year time frame, there would not be any sort of penalty for the individual. And so as far as the pool trust is concerned, the way that they look at the money in the pool trust is they'll typically take into account that the money that's been used throughout the person's participation in the trust for their sole benefit is not going to count towards any sort of transfer calculation. However, the principal balance of the trust may be considered. But it's important to keep in mind that if someone does have any sort of penalty period, the money in the trust could certainly be utilized to help get them through that period of time. So let's talk a little bit more about this look-back period and what it means for the nursing home stay and what it will mean in the future for this new look-back period we have for community-based services. So the look-back period is the period of time from the date that someone is applying for Medicaid services, where the Department of Social Services is going to look back from that date of application, 5 years for nursing home level Medicaid, to determine if someone made any sort of non-exempt transfers during that time. Any gifts or non-exempt transfers that were made within that 5-year period of time could create a period of ineligibility for someone, where they would be required to private pay for services for a specific period of time based on the amount of that transfer. Now, currently, the nursing home look-back period transfer penalty period is calculated based on the total amount of the transfer divided by the regional rate for the nursing home services in that particular region. Now, in the central western New York region, we're looking at, give or take $10,000 a month is the regional rate. So to keep it simple, if somebody transfers $100,000 and the regional rate for nursing home is $10,000 in their area, that would potentially be 10 months of ineligibility, where the family would be required to private pay for those services before Medicaid would be willing to provide coverage. Now, beginning after October 1st, there will now be this look-back period for community-based Medicaid services as well. So where under the current rules, someone could appropriately transfer that $100,000 this month and apply for Medicaid in August without any sort of penalty unless they go into a nursing home for 5 years. After October 1st, that same transfer would create a period of ineligibility for community-based long-term care services. And we're not entirely sure of how they will calculate this penalty period, but based on the regional rates and how they calculate nursing homes, we imagine it will be something similar to that. So what is this going to mean? New applicants for Medicaid services or community-based long-term care services, and that's really important to point out that this look-back period is going to apply to those who are looking to access community-based long-term care services. This is going to require that anyone who applies for Medicaid services, once this is in place, will need to submit financial records for them, the applicant themselves, and perhaps their spouse, from October 1st, 2020. Now, there have been some informal discussion that this could be, the implementation of this could be delayed, given the fact that, given the ongoing pandemic and the fact that we're under a state of emergency. However, they have stated that the transfers will be looked at from October 1. So any transfers after October 1 could create a period of ineligibility for someone who's looking to access community-based Medicaid services. And one of the concerns for the community is that having to pull together all of these financial records is going to not only potentially delay an application and make that process even more arduous and longer, that puts a lot of hardship on a family, especially if the individual is really in need of services. And so it'll be interesting, and we'll be certainly keeping an eye out on updates regarding how they plan to implement this. But it does sound like it will be implemented on a phased basis, similar to the way that they implemented the nursing home look back long ago, where let's say someone applies for Medicaid in January, they're only going to need to provide, the 3 months from October 1st to the date that they applied, not 2.5 years from, the date that they applied. So it really won't be until, a couple years down the road where someone will have to provide a full 2.5 years of financial records. But we are concerned about this potentially delaying someone's access to medically necessary services, particularly in the situation where someone's in need of the home care services, where when someone's in need of nursing home services, they're typically already in the facility and getting the services that they need. Whereas in home care, this delay could delay someone's access to getting the services that they need. Now, this look back period, it's been stated, will apply to home health care services, private duty nursing services, and personal care services, as well as the assisted services, long-term care services provided in an assisted living program, which is a specific assisted living facility that accepts individuals who are Medicaid eligible and provides services under Medicaid waiver. The Department of Health has also stated that they may designate others by regulation. So certainly just something to kind of keep an eye out for and keep in mind that there could be other services added to this look back in the future. But the Department of Health has informally stated that it does not intend to impose this look back for various waiver programs like OPWDD, TBI, and the NHTV waiver. Now, obviously, that has yet to be seen, but that is certainly something that we'll be keeping an eye out for. And I did include a link here to a wonderful resource from the NYLAG organization, and Valerie Bogart maintains some really great information, and she's been updating it along the way with new information that's been coming out. So if you have questions about Community Medicaid Lookback or any other of the upcoming budget changes that are going to impact Medicaid eligibility, feel free to check out that website. It's a great resource. So what does this mean as far as transferring assets and the ability to use a trust? So really important to point out that transfers made before October 1st of this year will not have any penalty for Community Medicaid. So if you're working with someone who's in need of Medicaid services or who anticipates needing Medicaid services in the next 2.5 years, or next few years, it may be beneficial to them to consider looking at their assets and getting to a point where they can spend down or appropriately transfer those assets prior to that October 1 deadline, so that in the event that they do need to apply for Community Medicaid anytime after that, that they would not be penalized for those transfers. But anything made after October 1 for new applicants of community-based Medicaid services could incur a penalty. And the transfer rules apply to both income and resources. Now, under the current rules, income hasn't been as much of an issue because you can't spend down income in a pooled trust when you're on nursing home level Medicaid. Once you go to nursing home level, all your income goes to the nursing home. But it is something that we're keeping an eye on, because if somebody makes deposits of income on a regular basis, the question is, how will Medicaid treat that, the deposits into a pooled trust? We're really waiting for more information regarding how they're going to monitor that. The Department of Health may require a periodic showing that the funds deposited into the trust are being spent on the beneficiary's needs. And that would be a pretty big change, also require a lot of work for the Medicaid offices. So it'll be interesting to see, would that be done annually, quarterly? There are certainly situations, for the most part, people are using their income every month. They deposit the money and they're spending it down to zero. But there are situations where someone may be saving that money to pay a larger expense, like their taxes, for example, or perhaps the individual is not utilizing all of the money on a monthly basis, but they are able to allow that balance to build up and use it for a larger expense that they might have down the road. And that's really helpful to the families that we serve. So we'll certainly be keeping an eye out for that. But it is important to highlight that the usual exceptions as far as exempt transfers still apply under the Community Medicaid Lookback period, which are transfers to a spouse or a disabled child, or by an individual under the age of 65 to an SNT or a pooled trust. So that's really, something that, is going to be very beneficial in continuing to allow people to do that. Currently, again, if someone's over the age of 65, they can transfer funds into an SNT. But right now, they only have to worry about that 5-year look back period. Once we get past this, if someone's over the age of 65 and they make a transfer into a pooled trust or an SNT, that could create an issue for their community-based Medicaid benefits, which again would be a big change. We included the reference to over 93's provision on transfers and trusts, because there's some really great information there about certain transfers. If somebody is looking to qualify for community-based long-term care services and they're over the age of 65, there are often many options for them. They will typically want to seek the guidance of a legal professional, someone that specializes in elder law or trusted estates, that can look at their situation and assist them in determining the best option to help their loved one receive the care that they need. So here are some examples, I think, that will help us kind of illustrate how this would be handled now versus in the future with a new community look back period. So Mary is a single individual. She's not married, but she is over the age of 65. She lives on her own. She has a variety of chronic health conditions, and she's applying for Medicaid to be able to provide her with home health aides to assist her with some activities of daily living. Her monthly income is slightly above the threshold to qualify for Medicaid, and she also has a little bit of extra money in the bank that she would need to spend down in order to be eligible. It's a decent amount of money, but certainly not enough money to private pay for home care services. Again, going back to that regional rate, that would potentially cover perhaps maybe 1.5 months of services, which would certainly be something she could do. So before October 1st, she's able to transfer or spend down that $10,000 either appropriately or a non-exempt transfer without and apply for Medicaid in the following months. So this month she can transfer or spend down her $10,000 and qualify for Medicaid in August, or apply in August. She'll only be penalized if she goes into a nursing home within 5 years for a non-exempt transfer. If she transfers the funds for something that is exempt, obviously that she would be not have to worry about the 5-year look back period either. And then her excess monthly income could go into a pooled trust on a monthly basis to pay her bills and other expenses. Whereas after October 1st, if she transfers any sort of money and it's considered a non-exempt transfer, She could incur a penalty period where she needs to private pay for her home care services for a period of time before Medicaid will begin picking up the bill. Additionally, she can still deposit her income into a pooled trust on a monthly basis, but she may be required to show proof of that money being spent on her needs. Again, we're not sure when or how, but that may be something that is required and following the implementation of this new community-based Medicaid Lookback period. Peter is single and under the age of 65. So he has been living with his parents for most of his life. They have provided care to him without the need for Medicaid services, but they're getting older and they're starting to need assistance themselves and can really no longer provide the care that Peter needs in the home. And so they're considering applying for Medicaid benefits to assist him with obtaining home care services through the Consumer-Directed Personal Assistance Program, which would allow him to kind of self-direct his care and have some control over that. The challenge is that he has a pretty sizable amount of money in a bank account that his family and he have been contributing to throughout his life that would make him ineligible, and he would be required to spend down before he can apply and qualify for Medicaid home care services. Before October 1st, he can transfer that $50,000 or spend down that $50,000, and he would only be penalized for a non-exempt transfer if he goes into a nursing home in 5 years. But because he's disabled and under the age of 65, he's able to deposit that money because there's into an irrevocable S&T or a pooled trust. Currently, there's no penalty for transferring assets to an irrevocable trust if it's established solely for the benefit of someone who's certified as disabled and under the age of 65. Another option could be to put a portion of that money into an ABLE account. Obviously, there's a limit on how much someone can put on an annual basis, and that exceeds that amount. But because he was disabled prior to age 26, he would be able to utilize that program as well. And that would not be subject to any penalty, even if he did go into a nursing home, because he made that transfer while he was under the age of 65. Now, after October 1st, and this can be any time after October 1st, that same transfer, he could incur a penalty if he applies for community-based Medicaid services within 2.5 years or long-term care services within 5 years. However, again, if it was deposited into an irrevocable trust, like an S&T or a pooled trust, that would be considered an exempt transfer. And so it is still something he could potentially do after October 1st, and may only be penalized if he's making the transfer not to an irrevocable S&T. So again, something to just keep in mind. This is where those individuals who are under the age of 65 do have some additional options when it comes to utilizing an S&T to qualify for these services. Now, our third and final example is John, who's also single and under the age of 65. He sustained a spinal cord injury and has been private paying for home health aides for a period of time. And unfortunately, he's beginning to quickly deplete the settlement funds that he received from his accident. The cost of these long-term care services are so high. And he's applying for Medicaid benefits to be able to access some personal care services. However, he has a large amount of money in his name that would make him ineligible for community-based Medicaid. So before October 1, he is able to transfer and spend down that money. And again, it's only penalized for non-exempt transfers if he goes into a nursing home in 5 years. He can deposit those funds into an irrevocable S&T or pooled trust as well. Again, as a disabled individual, he can do that as a non-exempt transfer because he is disabled. However, he cannot use an ABLE account because he was disabled after the age of 26. So an S&T would be the best option in his situation. Now, again, because he's under the age of 65. If he was over the age of 65, that's where there could be an issue with transferring that money into a pooled trust. And there's many benefits to putting that money into a pooled trust over an individual S&T because of the it's much faster and less expensive to establish a pooled trust. The cost to maintain that trust over the lifetime is typically less as well. And he would get the assistance of a dedicated case manager that specializes in working with people with disabilities. So that can be a very favorable option when someone's looking at, an individual S&T or a pooled trust, especially if they're looking for a professional trustee. Where a pooled trust has all the benefits of a corporate trustee at a much more affordable cost. Now, after October 1st, if he were to transfer or spend down that funds, he could incur a penalty for any transfers if he applies for community-based services within 2.5 years or 5 years for the nursing home. So again, perhaps he is not necessarily, going to apply immediately. Getting that money transferred before that October 1 deadline is going to help him if he needs the services at any point in the near future. And he's only going to be penalized for any sort of deposits or transfers that were made not to perhaps an irrevocable supplemental needs trust, because he's under the age of 65, when he's applying. But if he is over the age of 65 when he goes to apply, which in this scenario he wouldn't be, but let's say it was delayed and he turns 65, that would be the only time where he could potentially incur some sort of penalty period for that transfer of assets. So what does this mean for the people that we serve? How can we help them prepare for these potential changes that are coming? If you're working with someone who needs long-term care services now, do not delay applying. As I stated, under the current climate with everything that's going on with COVID-19, the Medicaid office is doing a lot to streamline the application process and try and make this as easy as possible for the people we serve. So it would be certainly a good idea for someone who's going to need these services to consider applying now, or at the very least looking at if they have a need to spend down funds and what are their options to do that. In addition to the look-back period, there are a number of other changes that are going to be implemented as part of this new budget, and one of those is that there will be stricter standards of eligibility for long-term care services through Community Medicaid, where people are going to be required to provide proof that they need assistance with a certain number of activities of daily living. And so because these standards are going to be stricter following this deadline, again, if someone is in need of the services now, it would benefit them to consider applying as soon as possible. For someone who has resources or planning that they need to do, and they anticipate needing long-term care services in the next couple of years, it would be a good idea to start planning for that now. Again, the transfers that are made before October 1st will not have any penalty for community-based Medicaid services. Now, we've talked a lot today about what we know right now and what we have heard informally in conversations with the legal community. However, there's a lot still to be answered. So we will absolutely be hosting additional webinars once this begins being implemented, and we will put out more information as it becomes available. So if you have questions, please feel free to contact us. I put together a quick slide here of the various pooled trust programs that we have available to assist the individuals that you're working with, depending on what their situation is. Each of these link to our website with additional information. If you have any questions, feel free to reach out to us. We're happy to discuss how to help somebody access these community-based Medicaid services both now and once this Community Medicaid Lookback goes into place. So with that, I'm going to open up the questions area, and we'll begin reviewing any questions that have been submitted throughout the presentation. We'll do our best to cover as many questions as we can. Certainly, we've thrown a lot of information at you in today's training. So if you have questions that either are not answered or specific questions where you'd like to perhaps speak with us offline, please feel free to reach out to us. My contact information is here on the slide, my direct contact information, and also the information to contact our office as well, reach the customer service team or our intake department. Give me one moment while I open up the questions here. Looks like there's just a question in the beginning here about how can I assume the slides be saved. Just like there is an area for you to go submit your questions, there's an area that is titled handouts. It says 4 of 5. If you click the arrow to the left, it will open up and you'll be able to download the PowerPoint and PDF versions of some brochures and the joinder agreement to enroll in a trust. If you would like those, if you're having any trouble with that, send me an email and I would be happy to share that with you directly. So there's a question about adult children living at home. Is that considered as the same as a spouse in regards to income? The adult disabled child income is 0. Parent is above the Medicaid limits. The adult child does not yet have Social Security. So I assume you mean as far as paying the home expenses. If somebody has a child living with them that is a dependent, typically, again, those home expenses are going to be paid in full if the parent, is responsible for those home expenses. That is certainly something that would be, reviewed on a case-by-case basis, again, depending on the situation. But if the individual is a dependent living with their family, with their parent, that's something where we're not going to prorate the expenses, especially if a disabled adult child has no way of contributing towards the cost of those bills. What is the amount of a transfer that Medicaid will look at? So it's really not based on an amount. It's more if it was exempt or non-exempt. Any amount could be considered a transfer, and it really comes down to the Medicaid office or the county to determine whether or not they impose a penalty for that transfer. So for example, let's say someone, has no resources really, and all they have is the $2,000 that might be sitting in their pool trust account that they haven't spent, and they're going into a nursing home. It's going to be up to the county to determine, whether or not they impose a transfer penalty for that. Unfortunately, there really isn't, a dollar amount. I think that they, that applies to. It's really more, was it an exempt transfer in which there's no penalty, or if it was non-exempt, it is certainly something they will review. We also got a question just about the PowerPoint is going to be available after the presentation. It absolutely will be. Like I said, it's in the handouts area, but feel free, again, my direct contact information is here on the slide. You can reach out to me and I'd be happy to email it over to you if anybody's having any trouble downloading that from the handouts area. Can a parent of an adult child who is only guardian of the person open a trust account for their child? So this is, where the individual is not able or does not have the capacity to sign a joinder agreement and establish a trust on their own behalf, where a guardian can sign the documents to establish the trust. However, if that guardian does not have the appropriate powers to manage and fund the trust, that's where it can put some people in a tough situation where someone has resources that need to be protected, but they don't have the capacity to sign or fund the trust themselves. If the person is really only a guardian of the person, they most likely will need to go seek additional permissions to be able to fund the pooled trust. They need to have the authority to handle the assets as well. There was a comment that the individuals that we serve should not leave any money in the pooled trust, to make sure that they spend all their money in the trust. Again, this is kind of what we've been talking about. It's still unclear exactly how Medicaid will be treating this. But because the legislation states that transfers apply to income and resources, we expect that it may be that necessary for someone to spend that money down and not leave any sort of balance. Now, Medicaid look-back period aside, we are always going to encourage someone to not leave funds in a pooled trust. They should be using that money on a month-to-month basis to support their living needs. They're applying for Medicaid services and they are using this trust to be able to cover those expenses. So no one should really ever be, allowing a large balance to build up in the trust, because unfortunately, if someone were to pass away suddenly, that money could be left, to the trust and they wouldn't have access to that anymore. So look back period aside, people should always be spending down their money in a pooled trust. However, as I stated earlier, there are some situations where people do allow the balance to build up so that they can make larger purchases down the road, and perhaps use that for bigger expenses. And so again, we'll have to wait to see exactly how they plan to monitor this. I think monthly would be totally impossible based on the amount of work that would be involved, and also we from an advocate standpoint would advocate for the fact that someone should be able to save up money for a larger expense throughout the year. But there is a chance that they would require proof of the money being used, and we're not sure when or how they would do that, but that is something that we will keep an eye out for and provide updates on as more information becomes available. There's a question about if the individual would receive checks that she can write against her pooled trust. So essentially where, they're given a checkbook for the pooled trust, where they would be able to, pay for bills with that checkbook. I don't believe, and I'm not aware of any option where that would be the case. Again, this is a pooled trust, so the bank account is one bank account for all of the individuals. So certainly not in our program. However, we do have the option of a restricted credit card, where we could authorize a credit limit for a, we would look at it as creating a budget plan for perhaps specific expenses that they may want to use the money for. These are evaluated on a case-by-case basis and at the sole discretion of the trustee to select someone who is going to be willing to comply with the needs to provide documentation for utilizing a card like this. But what it would do is, if any of you have heard of a Truling card, it's very similar to the Truling card, where we're able to basically authorize only specific venues that the card could be used at, and we can restrict payments towards things that are not allowable, things like alcohol expenses and perhaps specific vendors that we would not want the card to be utilized for. And that is something that is currently an option. So if you have a client who, could potentially benefit from utilizing that service, I would absolutely encourage you to reach out to us, and we'd be happy to discuss their situation. There's a question about if someone has a pooled trust with another agency, if it could be transferred to another pooled trust, particularly NYSARC in our case. And the answer is absolutely yes. If somebody enrolls in a pooled trust, they can always opt out of using that trust if they're not happy with the services being provided, or they find another program that may be better suited for their needs. And it simply is a matter of contacting the pooled trust they're with currently, letting them know they're no longer going to participate, stopping sending any sort of deposits to that trust, and then reaching out to the new trust company to establish a pooled trust with the new company. Now, obviously, we always want to encourage people to do their homework up front and pick the agency that's the best fit for them, so that they don't have to reapply for another pooled trust or incur another enrollment fee to establish a pooled trust. However, we understand, you can't always know everything when you're getting started. So that's absolutely an option. And most pooled trusts will work with the family if they're transferring from another trust company to take a look at the enrollment fee and see if there's any way to work with them so that, again, they're not incurring that expense a second time. If someone is excess resources of $10,000 and they transfer it to a child now, would that be exempt? So if the child is disabled, then yes, they can transfer $10,000 to a disabled child, and that would be an exempt transfer for nursing home level care. So again, if we're doing it now, then we're not talking about Community Medicaid Lookback. We're just talking about nursing home level Lookback. If the child is not disabled, they can theoretically transfer that money to a child, but it's not exempt. It is absolutely considered, an uncompensated transfer. And so if that person goes into a nursing home within 5 years of gifting that money, they could be penalized for that $10,000 that they gifted to a child that is not disabled. And so, it's important to keep in mind that, that might not be the best option. You get, because then that parent will need that money to pay for the penalty period. And if you can't get it back from the child that you gave it to, then that can put somebody in a really tough situation. So gifting money to a child that's not disabled is certainly something that you'd want to speak with a legal or tax professional about and discuss the potential ramifications of that under the current rules, and also, considering the Community Medicaid Lookback period in the future. Now, if they were to do this after October 1, where they transfer $10,000 to a child in order to be eligible for Medicaid benefits, and they apply the next month, they are going to be penalized for that from a community-based Medicaid standpoint now. Whereas before, they would really only have to worry about, as long as you don't go into a nursing home for 5 years, you're okay. Is there assistance if a client is in need of home visit to help set up the SNT? There's a client that the individual is working with who is blind and is unable to see, who greatly benefit from assistance with this. So unfortunately, at this time, we are not able to do any sort of home visits or any in-person meetings for the safety of our beneficiaries and our staff. However, this is something that we can provide virtually. Now, I understand the individual may have some challenges with that, being visually impaired, but perhaps there's a family member that may be able to assist with that, or a service coordinator, or someone who is able to meet with the individual and meet with us virtually. We do provide particularly we are usually helping people with these applications and the onboarding process entirely over the phone. So that is an option as well. I mean, that is the primary way that someone enrolls in a pooled trust in our particular program. So we could certainly assist them that way as well if a virtual video option is not available. Should we be encouraging consumers with Medicaid with a spend down to establish a pooled trust in order to meet the monthly spend down if they do not have enough medical expenses to meet their spend down, especially when they need long-term care? So, again, it's really up to the individual and the family. But yes, this is where if somebody doesn't have enough money or enough expenses, medical expenses, to be able to add up to that spend down month, they're going to have a difficult time meeting that spend down. But even beyond that, using that money towards medical expenses, even if they do have enough medical expenses, could potentially put them in a situation where they're having a hard time paying their bills. So whether or not they have enough medical expenses or not, it could potentially benefit someone to consider using a pooled trust. And again, it's really going to be individual on the person's situation, but giving someone that ability to continue to utilize that excess income, that income that they worked hard for their entire life, to be able to maintain their standard of living and improve their quality of life as their care needs progress over time, I certainly would encourage someone to do that. So we thank you guys all very much for joining us today. It looks like we don't have any other questions at this time. Like I said, please feel free to reach out to us. We would really appreciate if you took a couple minutes to fill out that survey and share some information with us about how you felt about today's training, and certainly any other ideas that you have for additional trainings in the future. We hope everyone is staying safe and be well.